introduce you. So Martin Roberge, Managing Director here, Macro Portfolio Strategist here at Canaccord Genuity. I'm Rob Tatro, Portfolio Manager here at Canaccord Genuity Wealth Management, head of the Tatro Group. Thanks everyone, now on all our platforms. Martin, we talked about the rally. And again, I should remind everyone, don't take this as investment advice, please. This is my quick disclaimer. My job is to give my clients advice on their particular situation. Your job is to give, global advice, macro advice, to talk directly to investment managers, portfolio managers, institutional managers. Martin does not know your situation. So, don't take this as advice. If you're not sure, go to www.speaktorob.com. We'd be happy to take a look at that. All right, Martin, you just talked about the rally in the market. So where does that put us now? The S&P 500 is approaching 2,800. Are we just going to kind of slowly go back? You talked a bit about retesting. Tony Dwyer, I've talked about it before. He believes in a retesting. You believe perhaps this is different. You believe maybe this is a range.
Yeah, I'm more in the range camp, and I do not rule out a retest, but the challenge sometimes is that there are no retests. Maybe Rob, you can show us another example of
the 1929 example.
Yeah,
give me one sec. I'll pull it up.
Yeah,
that's this one, I believe, Martin. Yeah, so hopefully that's somewhat clear for the viewers.
Zoom it. Yeah. So it's the reason why I like first of all, like, we're not headed into an economic depression. Okay, like back then, central banks did several mistakes along with the governments that we had a 3-year depression. Actually, this time around, the fiscal and monetary authorities are doing the exact opposite to make sure that we don't relive this episode. So, but the reason why I like 29 as a possible roadmap is that it was a crash. It was almost a 70% haircut, peak trough, in a very, very short period of time. And when you see a condensed or compressed market crash, sometimes you rebound, and the rebound is so powerful that you don't retest those lows, because the harder, the bigger the decline, the bigger the response by the governments and the central banks, so that once you get those positive responses, the stock market will normally enjoy a big bounce as well. And the fact that we're seeing a series of positive bailout plans is protecting the downside, and this is why we sometimes do not retest the lows, because the government and the central banks just keep on adding or announcing more and more and more stimulus. So it seems
that's going to be my next question, Martin, because this is an unheard of stimulus. I do want to let you finish your point, but that's definitely going to be my next question.
Yeah, but that's what we had a little bit early when we bottomed out in 29. But the problem is that they did not continue with the reflation that was needed to get the economy going. So this time around, the amount of stimulus that we've seen from governments, both in North America and around the world, is unprecedented. Yeah.
No, sorry. Go ahead. I'm told by my producer, my show producer, that any chance you could put your phone the other way, horizontally?
Oh, like this?
Look at me. Yeah, your face is a little high, but that's okay.
But I can put it like this.
There we go. We're learning on the fly here, folks. Thank you everyone again for joining us. Martin Roberge was just telling us about the drop in 1929. Now, I think one big, and I'll get to the stimulus in a sec, but Martin, one big difference that I think we need to reference is that 1929, what was the fall, like 80% or something like that? What was the
70%.
Yeah, 70%.
And then don't forget, economic growth, like industrial production was down 40%. There were tariffs, like people, like there was no monetary transmission from the central banks to individuals. Today, we've got electronic payments. As we heard from the governments, you're going to get your paychecks, your income, your government income, like in your check account, like in a week or 2 weeks from now. And then back then, gold was the standard, so it was very easy for people to go and buy gold coins as opposed to buying financial assets. So it's totally different.
Yeah, I mean, people were lining up around the corner to get their cash out of a bank. You know, people were you had no bid on a whole bunch of assets, farmland and stuff. People were starving. People were dying. It's a dramatically different era, right?
Yeah, and what you'll see when you get, I believe, Rob, you're going to get Tony Dwyer on your show in the coming weeks, and Tony has a good understanding of the various credit cycles in the U.S. and the key when it comes to dealing with a recession is to make sure that credit continues to flow, that credit is not shut down. Banks continue to lend, consumers continue to borrow and consume, and companies continue to manufacture. So this is exactly the recipe we have delivered from the Bank of Canada, from the Liberal government, from the provincial governments. We've seen a proactive people making sure that the economy is not shut down because of the lack of bank lending or the lack of borrowing capacity, the lack of income. So you've got financial backstops, employment backstops, making sure that the wheel continue to spin. But again, the only question mark is the duration of this pandemic. Like, is it going to be a 3-month kind of a halt? Is it going to be 6 months of a halt? Like, we just don't know. That's the only uncertainty left. But from my personal experience, what we've seen so far in terms of response is just unprecedented. Just to give you an idea, back in 2008, 2009, when we had the global financial crisis, the various stimulus plans totaled about 5% of the economy in the U.S. And right now we're talking about 12%. Same thing for Canada, about 10% of our economy. The equivalent of the stimulus in Canada is equivalent to about 10% of our economy. This is huge and unprecedented. So I have to admit that these guys have done their job. Now it's a question of finding the right equilibrium between, earnings growth prospects and the right valuations for stocks, because the other side of the coin is that things are going to get more challenging from the earnings side going forward.
It's not going to be pretty, right, Natcan? Like Q1 is going to be probably okay, I would imagine, because depending on when you got impacted by COVID, but Q2 earnings that are going to be what, August-ish, something like that. The earnings are going to come out in August. Q2 earnings are going to be disastrous, aren't they, Natcan?
Yeah, they're right now the consensus of analysts. They are predicting 19% for Q2. Then
you're talking a haircut for a 19% haircut.
19% haircut for the whole year, though. And this is why down the road there could be also some downside volatility. Is that for the whole year, the analysts are looking for only 9% for the whole 2020, and we are assuming 30%. Just to give you a perspective, yeah, I'm looking for 30%. The street is now at let's say 9%. But again, like the earnings season starts next week, so we should see companies providing lower guidance for the year and get to my number. But again, the flip side of this is that 2021 we should see a pretty good rebound, and this is where we've got to keep our eyes on is 2020 is probably a wash earnings wise, but if we look at how economists are looking at the recovery, 2021 should be a rebound year for earnings, and normally the market will start discounting this rebound late in the back half of the year. So as far as downside risks, the next 3 to 6 months likely to be pretty choppy, but the market will be very quick at looking out to 2021, where things should be a lot better.
Yeah, I mean, you sent out a comment. So I do want to talk about earnings, and maybe I'll just pause right here and just remind our viewers that earnings, companies have to report earnings. They're mandated to report earnings quarterly. They're mandated to give the best of their ability guidance on what they think might happen. They can't kind of withhold information. The reason our market is efficient generally, the theory is that it's public, it's disclosed, it's transparent. No one has an advantage, no one has a competitive advantage. Therefore, we're all kind of getting the information at the same time. Analysts, experts like Martin and others at other shops, they put out a target for what they think earnings will be. And in this case, Martin has just said he's expecting a 30% haircut, correct, Martin, you said?
Yeah, 30% haircut followed by a 20% rebound.
Okay, so that would take us to most of it back next year. So a V recovery on the earnings, not necessarily on the market, but on the earnings.
Not necessarily on the economy, not necessarily on, and don't forget, analysts or companies will use 2020 for a kitchen sink. We use like a kitchen sink, like they throw everything, all the bad news, they throw everything in there to make sure that they start 2021 on the clean deck.
This is something that I don't think is mentioned enough, and I don't think the retail consumer, the viewers out there, kind of have any inkling about. And even for guys like me, it's tough. How do you measure a future stock when you're going to have a quarter or 2 quarters of basically no income, and then in theory it's coming back? There's no real models that have been built for this specific COVID situation. This has never really happened. Something like this where kind of the world stops, for 3 months or 6 months or 2 months or however long it is. When you're doing the modeling out, I know you talked about looking at 2021. So when you do your target for end of 2021, I think I have a slide on this. Take us through how you've done it, how you've measured earnings, and what you kind of see as a target for end of 2021.
Okay, yeah, all right. So if you have to look at historical recessions and to gauge the duration of the earnings contraction and the magnitude of the contraction. And historically, on average, over the last 12 recessions, earnings will drop 22%. Okay, and we have on this chart.
Which one am I? This one here, right?
Well, on the second. Well, this one is just like to compare where we are relative to 2008, and that's a good reference point. Okay, in a way, because we had a like, especially if you look at the first panel, the global economy really got hurt badly, and back then earnings dropped 50%. Okay, peak trough decline of 50%. For now, I'm using 30 because I'm seeing a quicker recovery in the back half of the year. Like 2008 and 2009 was almost a year and a half of weak growth. This time around, it's likely to be 3 or maybe 4 quarters max. So we could happen to drop 50% till maybe like July, August, September. But if I'm right, Q4 should normally be the quarter where we improve, so that the year-over-year decline will be around 30%. 30% is more than this, like the 50% is a 2008 average. But if you look back again and use more than just one recession, the average is about 22. So I'm 30. I'm pretty severe. Okay,
yeah, you'd be one of the more bearish, bearish or negative on the earnings.
On the earnings, and but you see, there's a snapback eventually coming. So I have to account for this snapback, and the snapback. If you look over 2021, if you just average the 4 quarters, total, if you sum the 4 quarters in 2021, you get about a 20% lift. And that's why I'm using that 20% lift. And
so then that takes us to the target for end of 2021, right?
Yeah. So you can see, and let's focus on the S&P 500. Maybe you can zoom, maybe the first table, Rob. Okay. So you can see, like, I'm not going to get into the mechanics, but I want to show you on the far right, 112 is the dollar of S&P earnings, the number, like in dollar terms, the earnings that S&P companies could generate if we had a 30% haircut. Okay, you can see that the fair value, if we have a 30% haircut, would be around 28.15, and this is exactly almost where we bottomed out in March. Okay, we went a little bit lower, but a 30% haircut brings a floor around 2,300. Then let's assume that now we rebound in 2021. So we go to the left. So we rebound about 20%. So it's a lifting 112 times 20%, and you get roughly to 135. And then the 135 gives you a fair value of about 28, like 27.78. Round it up. That's your 2,800. So this is why, Rob, I like this range bound view when it comes to dealing with the market. I want to add to my equity positions when I get close to 23 or below, and then I want to reduce the risk in my portfolio or start maybe scaling out a bit when I get to my fair value around 2,800.
Today matin, that the S&P finished at 27.89, right around this number right here.
So that tells you that folks that were looking for a level around which they could take some profits if they bought like a 3 weeks or a month ago. That's a tactical exit point. But obviously, this is a tactical story. From a longer term story, you should not necessarily rely on this range. But if you want to play 2020, the right way, I believe, is to keep the discipline of lightening up a bit around 28 and be more aggressive when you get to 23. Obviously, some stocks have been, like, you look at the rebound in some of the stocks, some rebounds have been too far too fast, and some rebounds have been too weak. That's why it's a stock by stock approach that we have to take, as opposed to a market based approach. Okay, and that's your job. That's not my job, Rob.
Hey, Martin, we're getting some questions, a lot of traction here on some of our platforms online. I'm gonna ask you a few of them. With respect to the stimulus, agreed that it's been good for the governments that they acted quickly, but with a 10 to 15% GDP already committed, how much further can they go if the virus stretches out? Can the stimulus continue for 6 to 12 months? And maybe you can contrast that with the world wars, how much we spent in the world wars. You know, I think it's like 25 or 30% or something, and how long it took for us to get that back, and what your thoughts are on that.
Yeah, the money that the government can spend is approaching a limit. Let's remember, you can spend, the Federal Reserve can spend, okay, and the government can spend. The government is limited to how much it can spend, because from a math point of view, once you get your total debt above 125% of your GDP, just the math is such that it's tough to get it below 100% again. And normally that's why the 125 is the limit. And we're going to be playing with this limit by the end of this year. So from a government spending point of view, they are getting pretty close to the end line. Okay.
Where would we be in Canada? Would we be higher in Canada than the US?
No, I can't. No, Canada, we're lower. Okay.
Lower.
Canada,
Okay.
we're way lower. Okay. I think we're talking about, but don't forget, like, yes and no, because if you combine federal debt, provincial debt, and municipal debt, you're around 100. Okay, the federal is around maybe 37, 40, but when you sum the three governments, you're around 100. But they have more room to maneuver there. But the flip side, or the positive, is the Federal Reserve can print, can grow their balance sheet, or can print, issue more debt, and grow their balance sheets. And to the extent that in the US, the balance sheet is about 50% of the country GDP. Once we account for what the Fed has announced, it will be about 50% of the GDP. In Japan, you're near 100. In Europe, you're near 75%. So there's a lot of room still for the Federal Reserve to grow its balance sheet if it wants to. Okay.
Do you think we'd see another bazooka? $2.3 trillion. For those of you who don't know, this is news. If you didn't catch this, $2.3 trillion to the U.S. Today. Do you? I think you called it a bazooka, or maybe I called it a bazooka. Do you see, like, there's no way they're doing another $2 trillion later this year, or do you? Am I wrong?
No. This is why.
This is it, right?
The next step, Rob, will be, and for those on the call will remember GM probably. The next move will be probably for the government to recapitalize the companies that are deemed too big to fail. Let's say there's a Delta Airline, American Airline. The government has allowed these companies about $60 billion in total of bailout money. Well, if they use all that money and they need more, well, the government will say, hey, we're done. Like, we've got no more money to spend. So what we may do, though, is that we're going to buy an equity position in your company. So
diluted, right?
Yeah,
So,
and when you ask about the next black swan or the next market risk, it could be related to those situations where some corporations have to be recapitalized, and then Rob, how it goes. The government calls large institutions and they say, okay, how much do you want? And then the institution will say, I'm not going to buy this company if you don't backstop the debt. And then the government will say, I will backstop it. And that's why today the announcement is a quasi backstop of the corporate debt in the US, because that's the natural sequence. Once you backstop the debt, then you can go to your large equity investors and you say, hey, okay, now the going concern risk is over. How much do you want and what price? And then the pricing power is in the price of the equity holders. And then, Rob, you could decide, I want to pay $5, $6. Then there's an auction, or there's a level around which everybody is happy. So this is normally done with the large institutional money management. And this is why you have to be aware that if it's good for these guys, those large professional investors, it's good for you and your clients. Okay.
Yeah, we've talked about this internally on our team many times, and this topic specifically came up, and I think you and I talked about this last week on one of our calls. But hey, I want to take a second and ask the viewers at home, what are your thoughts about corporate bailouts? The viewers on Facebook, the viewers on YouTube, on the different platforms, what are your thoughts about corporate bailouts? The government stepping in, putting money just either as a loan or a grant? Or then what are your thoughts about equity bailouts where they come in and they buy shares, as Martin was just describing? They would buy shares, and then, you know, you as a shareholder, you get diluted, so there's more shares now issued. Do you feel that's right? Do you feel the government should get involved like that? And are there different ways to do it? Because Martin, you know, do you see that happening? Do you think the airline industry, for example, or the cruises? Let's talk about the cruises or the airlines.
I don't think in Canada we have this situation. Okay.
What about Air Canada? What about Air Canada?
No, Air Canada has a lot of they have about like $7 billion of cash on their balance sheet. So I don't think there's a solvency risks there. And if there was a risk, like that's the only national carrier we have. So it's obviously the company would and then they can do all sort of the government can buy commercial papers, short-term debt.
Well, that was going to be my question, Martin. Like in Canada, you don't ever see a situation where you'd see a GE or GM situation or a Citigroup situation where the government takes equity and therefore like knocks a leg off of our only national carrier, right? You don't think that would ever happen. It's a pound of flesh.
Well, it's very rare. Like we had situations where, like if I recall, back then it was Tech Cominco during the crisis. The government in Alberta injected debt and took an equity portion, but the company was still alive. The company was still listed. The company did not file for Chapter 11. So normally we don't go because our companies are not big enough, are not multinational companies, and they carry, normally U.S. companies will carry more debt on their balance sheet. So in Canada, we have been always more conservative in the way we manage our balance sheet, while in the U.S. it's kind of the opposite. And for deep cyclical and capital intensive industries like airlines, like we've got several airlines in the world, and no way the government can bail out every single one of them. Okay, so I think this is more of a risk in the U.S. than in Canada. But still, if you own and you want to buy for a rebound, a Delta airline, well, there's always a risk. Okay, even though the stock is very, very cheap, and even though it has fallen quite a bit, you have to be careful. We didn't think that GM would go bankrupt. Ford traded as low as $1 in 2009. So, Rob, you don't have to go there if you're a money manager. Do you really have to go there? There's enough quality in the market out there.
I agree. You're preaching to the choir, Matthew. I agree 100%. It's just questions I want to cover. Hey, I want to ask you another question about the oil patch. So question coming in here online, Eugene again, asking me about whether or not Canadians would be better off paying $1.50 a liter of gas at the pumps with a healthy oil industry, or whether or not Canadians are better putting all that savings in their pocket and sacrificing the oil industry.
Maybe pay 1/3. Maybe pay 1/3.
Keep the jobs, right?
Yeah, it has to be both. It's a give and take. I think that the turn towards like ESG regulations is
ESG
unavoidable.
For those at home, environmental and social governance. Is that right?
Yeah.
It's socially responsible investing.
Yeah, and it's unavoidable. We are doing. It's kind of a long cycle, and it's like it's 2 steps forward, 1 step back, but strangely enough, we probably need the participation of our energy industry to engineer this turnaround. So and then we've got to give them time to do it and the right conditions to do it. And this is, I think, what's behind the government support plan for the energy the energy sector. We have to realize that we will need in the U.S. we'll need also down the road our oil, because they are now becoming, actually before this COVID-19, the U.S. was a net exporter of oil, And what's happening is that as the shale oil is getting depleted down the road, U.S. refiners will need more and more oil, to meet the gasoline demand, the jet fuel demand, and eventually they will need oil from Canada. So we have to have the infrastructure, or keep the infrastructure, to eventually meet the demand of those refiners. And if we don't have the infrastructure to get that oil down to the U.S. or into the global markets, oil will have to come from somewhere else. We're gonna start re-importing oil from foreign countries, and with a loonie at 70 cents, Rob, it's gonna cost a whole lot of money to get that oil. So we have to make sure that we keep the infrastructure to eventually meet this demand, where the more oil the U.S. Are sending to global markets, eventually the faster the reality where U.S. refiners must get their oil from Canada as opposed to get their oil from Cushing, that will become a reality faster than everybody expects.
Okay, hey, I'm going to ask you a question about, you just talked about the loonie. I want to ask you about that, and I'm going to pull up a slide here that you sent me, I think it was last week. It was with respect to the dollar.
That's the
sorry,
US dollar.
US dollar, excuse me, the currency, US dollar appreciation. Yeah. Sorry. So this is one of the things that you've talked about in the past. What are your general thoughts on the US dollar right now with respect to this recession? And then how do you see the loonie in that, is a question we got online.
Yeah. All right. So this chart, I don't know if you can see it well, is whoops.
I got it. I got this. I can do this. No. Zoom. There we go. Okay.
Right in the middle of the chart, you can see we're at 100, and the 100 is the historical bottom in the S&P 500 around recessions. So I look back at every single recession and where the bottom was on the S&P 500, and I said to myself, okay, historically, what does it need? What do we need to see for the S&P to really put in a bottom and then rally? So if you look 1 year before, 1 year after, you can see that going towards the bottom, which is 100, like moving from left to right, okay, going to the S&P bottom, the US dollar gets bid, okay? The US dollar always appreciates because it's what we call a
safe haven currency, right?
A safe haven, okay? Then once you get to the bottom of the market, it's paramount to see a weaker US dollar, because, as you know, the world the world needs that US dollar oil to function, to operate. And the reason is because most of companies around the world are borrowing in US dollar terms. So the higher the US dollar, the greater the demand for this US dollar, and the more restrictive it is on the economy, because those that have borrowed in US dollars have to pay more debt, have to pay more to service that debt, because the dollar has just gone up. But it's the other way around. When the S&P eventually recovers as the Fed cut interest rates, as we see more reflation, eventually the solution to get global growth going is to flood the global economy with US dollars. And once you see like a 7% correction, like moving from 100 to, let's say, 94 on the chart, you can see that it's this highly stimulative for the economy and the stock market. So if the US dollar needs to depreciate for the stock market to stabilize and eventually resume its uptrend, by default, a lower US dollar will cause a re-rating in the Canadian dollar. Hence, my view of that bounce. Okay.
I was 2 weeks ago, I was on this show and I got asked the question about Canadian currency that day, I think 2 or 3 weeks the dollar was at 67.8 or something like that. And I read your comment to my clients, and you called it perfectly. You called a short-term bounce followed by kind of short-term bounce for the Canadian dollar, followed by long-term appreciation by the U.S. dollar over the next period of time due to just the strength of the U.S. economy versus the Canadian economy. Has your view changed on that, or you continue to believe that long-term?
Yeah, long-term we're trapped. Like long-term, Rob, it is 75 cents plus or minus 5 cents. That's the range. Historically, for Canada to enjoy a much stronger dollar, much stronger Canadian dollar, you need Canada to generate trade surpluses, a current account surplus. And in order to generate a trade surplus, you need to be able to get your oil out of Canada. So as long as we've got the pipeline bottlenecks, it's going to be almost impossible to generate trade surpluses. And along with all the deficits that we're generating, we're capped at 78.80 cents, which is what we call a fair value. Okay.
Yeah, you would never get in the times right now, we have a trade deficit, so we import more than we export.
Yep.
And we also have a fiscal deficit.
Yep.
And those two deficits, you would never get an 85-cent dollar.
No.
Never mind 80. It wouldn't go above 80.
Nope. And you remember, people are will remind us of 2007 and 8. But oil almost hit 140 back then. You remember?
Yeah, so we were pumping a ton of oil out, ton of Canadian demand for the dollar.
Yeah, and then that's right. You got it. Okay, so but we're not going back there. Okay?
Yeah, until you see that turn, the trade surplus turn, and you're saying the trade surplus is not going to turn unless we have oil that we can send at $60 a barrel or $70 a barrel. Until then, we will be in a negative trade situation.
Yeah,
and our fiscal deficit.
Hence the range of 75 cents plus or minus 5 cents on both sides. Okay.
I'd be more thinking on the downside, but regardless, and the fiscal deficit, we're not seeing that go away anytime soon. We just pumped 10% of our GDP into stimulus, and so good point. Thank you for that. Hey, I'm getting some questions online here, Martin. I'm going to just ask you maybe just real quick. Do you ever see WCS going no bid? No.
No.
Do you ever see WCS going negative?
No.
No. Okay.
No, I've never seen that.
Okay, and two, what's question online here? A good equity buy strategy for a modest personal portfolio. So this is, what kind of names, I guess, would you focus on if you could only pick up, modest portfolio? Maybe it's a small portfolio. You can't get that many positions. You said yourself you don't want to get ETFs. You don't like that exposure. A couple names you'd put in there. Maybe. Would you focus on Canadian, US, or would you stick to just Canadian for someone who's got a modest portfolio, just a few names that they can put in the portfolio?
Yeah, as you know, Rob, I'm not allowed to give names.
That's right.
Names on any shows, by the way. But
I knew that.
I can talk certainly about their regional exposure. Look, there's no way around the US. This is where you get what we call the growth exposure. Growth exposure in the rest of the world is very, very modest. So you have to have actually I ran an analysis showing that for a Canadian-based investor, the optimal risk return ratio is when we put 60 to 70% of our capital in US equities and 30 to 40% in Canada. And the reason is that long-term returns are higher in the US because of more growth companies in the index, okay? And then on the way down, when we have a correction, the Canadian dollar goes down. So it protects our portfolio, okay? Don't forget, like up until recently, not too long ago, the loonie was 76. Almost
80,
77.
79, 80, yeah.
And then we went all the way down to 7. So that 10% correction is a gain. If you have this exposure in US stocks, it's a gain. So the 34% decline in reality for a Canadian investor is about like 27. Okay. So we have to remember that.
This is exactly what we've practiced for asset allocation. We've always been about a third Canadian and 2/3 global US or USD basically. But we've been less and less than that lately. Less and less Canadian lately, anyways.
And
we're going to say, sorry.
And then Canada looks like most other markets in the world. But since in Canada, we've got so much debt, corporate debt, that companies outside in like in Germany, France, in Europe, Japan, emerging markets, those it's not in their culture to borrow to buy back stocks, for example. So the level of debt on corporate on balance sheets in Europe and Asia, like it's very, very low. So balance sheet risk is very, very low. So unfortunately, I have to put Canada almost at the bottom of my pecking order when it comes to regional or geographic allocation. So make sure that in your portfolio, Canada does not represent more than 30-40% of your holdings.
This is a serious problem, I think, and I've talked about it before. If you guys have watched my videos, I've talked about this before, and I've talked about it on this show before. I see statements every single week. I see statements from people coming in. They sit down across from me. They show me their statements. Well, they don't sit down for me now, but regardless, and they always a dramatic overconcentration in Canadian stocks. You know, they're at a typical bank. It's a cookie cutter portfolio. It's all Canadian equities. It's all the same names, and it's all they have in their RSP. And I'm just blown away how this continues to happen. It's 2020. The rules with respect to, you know, asset allocation and RSPs changed in the 90s or 80s. I don't even know, a long time ago. And yet we still see accounts that are loaded up with Canadian stocks, and they've dramatically underperformed. You know, the TSX was at 14,000 12 years ago or 15 years ago. Like it just, I would agree with you. And I'm glad you mentioned that, Natcan. I want to ask you about corporate spreads. So now I want to ask about fixed income or bonds. You mentioned it earlier, and I want to come back to it because some bonds, the spreads on them have moved so much that you could buy a bond for 80 cents or 85 cents on the dollar, or you could buy a bond fund that's down 10%, that's well managed. What do you like in the near term? Am I wrong to think that there's going to be a ton of influx, ton of bids happening with respect to the U.S. Fed, and in theory the spread should narrow in a relatively quick manner? Yeah,
especially what we've seen today in terms of announcement, like the Fed is now backstopping the corporate bond market, and actually even like some of the high yield market. The Fed is not allowed necessarily to buy the secondary market, okay, but it can certainly do it at the primary bond issues, and I think this is my understanding.
But doesn't it just move it? Doesn't it just move it down the line, Natcan? If you're buying it here,
yeah, it's going to move it down the line, and this is why, from a risk-reward perspective, corporate bonds in the U.S. are yielding maybe like 5.5%, some maybe 6%, like investment-grade bonds.
I know,
Rob. So I think this is not too shabby. Like this is not that bad. Like when you get rates at zero, it's pretty nice carry. So for risk return, I would probably argue that corporate bonds provide a better risk reward ratio than stocks following this week's rally.
The argument basically goes like this, and you can correct me, but you're going to get 5.5, 6 yield on investment grade debt, 5 to 6 yield. You're going to get, if you're buying bonds at 90, 92 cents, you're going to get, that 10% bump. Now, whether it happens in 6 months or 12 months or 18 months or 24 months, those investment grade companies, they're pricing in a default rate that's not going to happen. There's no way we're going to get.
And then because you're going to get you're getting the backstop from the government in many cases.
Yeah, they're not
risk reward.
Up.
You get the upside, the full upside, and on the downside, you don't get the downside of the equity market.
Yeah, so this would be an area, if you're sitting in cash, and you maybe don't need the money for 3 years, and I'll let you comment on this, but if you're sitting in cash and you don't need the money for 2 or 3 years, it's not a 10-year horizon, and you don't really want to go into the stock market, a great place to be would be short duration corporate investment grade corporate debt, guaranteed investments. They have an underlying guarantee. They're down, they're trading at 90 cents on the dollar. You hope to make that 10%, but you're going to make 6 as well on the yield, right? That's a decent play.
Yeah. Well, I'm not sure about the short-term yield where they stand, but
Whatever it is.
the 20-year, the 10 plus are around 5.5%, I believe. So the short term should be around maybe 3-4%.
Yeah. So, but the play is not necessarily the yield in that situation. It could be a combination of the yield and the capital appreciation.
And obviously the capital appreciation. There's one thing, Rob, that if things go bad on the way, like if for example, people are scared that there's so much debt in the US that the government will need to issue so much bonds that eventually it's going to put upward pressure on yields. Well, they could decide to cap the yields, like they did after post-World War II, where they decided that they would buy anything above 2.5% because they don't want to see the economic recovery being impaired by a backup, too much of a backup in bond yields. So we are starting to see rumors about that. But if they decide to cap the bond yields, well, it's going to go down. It's going to go down the curve for corporate and high yield bonds as well. So I think you get very limited upside in yields for investment grades. And if you go back down, because and I don't know where they will do it, Rob, but if they decide to do it at, let's say, 1% on treasuries, well, that your corporate bond yields is not going to 6-7%. Okay.
Yeah.
So
it's gonna have the same trickle effect.
Yeah.
And not only that, for those at home that don't maybe miss that comment, the point that Martin is making is that by putting a cap on the yield, bond prices and yields have inverse correlations or opposite correlations. Therefore, if yields cannot go higher, bonds prices cannot go lower. So it'd be making sure that your bonds are not going to drop in price. And now that's an incredibly neat point, Martin, that I've not heard anyone make until today about the war and about, like, I knew it was in their back pocket, but I did not know that you're hearing rumors about that. That's pretty neat.
Yeah, because that's the next step. But because they don't want to, let's say that they're successful in getting the economy going in a year or 2 years from now, okay, and then the bond yields are pricing this recovery. Well, you know what? If bond yields go from like 1% to 3%, we have to kiss goodbye the housing recovery, and the whatever is sensitive to interest rates will get impaired. So to make sure that you don't derail the economy on the rebound with too high of interest rates, they cap it.
Okay. Reminder, folks, I'm here with Martin Roberge, managing director, portfolio manager, and senior portfolio strategist at Canaccord Genuity, advising all of us institutional managers, mutual fund managers, portfolio managers, dealing directly with the big money. Martin is a wealth of knowledge. I'm thankful. I want to ask you a question about, so you go home, it's Friday, you've had a long week, you sit down, what's your drink of choice?
IPA, West Coast IPA.
West Coast IPA.
Yeah.
And that's a 5% beer, I would imagine?
Well, a double IPA is 8, but I will have only one of that one. I will have 2 6%.
Okay.
Well, yeah,
okay.
I don't know about the folks and the rest of Canada, but down here with my boy, like the hockey, the locker room, and the boys, when we go out after the game, like we no longer drink Coors Light or Labatt 50 or like we drink all the IPAs right now. Like we like the IPAs.
You like the IPA. So on my hockey team, I'd say the split is probably 40 to 50% Bud Light, and then there's a split between Moosehead and some
Heineken,
cheese, Heineken, stuff like that. But I'd say like the old kind of traditional water tasting beers are still getting about 50% of the market share. That's over.
But for our team, it's over.
It hasn't come here yet, Martin. It has not come to Manitoba yet. Not at least on my hockey team. By the way, shout out to Les Curés, mon équipe de hockey. Martin, I want to ask you one last question. We're getting a ton of questions about inflation, and then we'll wrap it up here. I want to ask you about inflation. We're printing money like crazy. You've touched on it a few times today. Is there a situation that you can talk to me about what you think is happening in inflation after we're done with COVID?
Okay, first, if I break up, I've got 5% left, 5% battery left. Okay. So I cut off. Forgive me. Inflation is not going to be a problem for the next 2 years, because in order to have a sustained increase in inflation, you need to have wage inflation. And since unemployment, as you know, unemployment rate is at probably 15% this year, maybe going to 20, the pool of labor is going to get like bigger and bigger. So it's going to take a lot of economic growth to shrink that pool again and create wage pressures. So without wage inflation, you cannot get outright inflation. But what you could get is what we call rising inflation expectations. Like it's what we call the second derivative, or
a second derivative,
expectations moving towards an inflation scare down the road. And this is usually enough to move some asset classes, such as real return bonds, gold, commodities. And we know that the solution for a better economy is a weaker US dollar, which is obviously inflation sensitive. Okay, so inflation is not going to be an issue for the next 2 years, but I think we have to start building portfolios that will do well when inflation expectations are rising, and I think we are there. Okay, and that's why I really like like what we call the real assets, tangible assets. Commodities is one group. Obviously, gold, real return bonds, and as you know, Rob, it's been beaten up so badly. The natural resource stocks, I think, makes sense to have a little bit of exposure there, like what we call commodity stocks and outright commodities. So that's
Martin, you've called it right since I've been here at Canaccord. Since I talked to you the first time in my office here, I don't know how many years ago that was. You've called it right pretty much every time with most of the macro calls. So I'm incredibly thankful that you joined us today. Reminder, folks, next week, infectious disease specialist on Monday, Mark Leishman joining us. Mark Leishman, the professional PGA Tour golfer, 5-time winner on the PGA Tour. He will be joining me live in Martin's shoes Thursday at 3 p.m. Central, 4 p.m. Eastern, right here. Mark Leishman, professional golfer. Today, I was incredibly thankful and happy to have Martin Roberge. Guys, please take a minute to subscribe. Go to our YouTube channel. If you're on there, subscribe, like the vids, send me your comments. Go to www.speaktorob.com if you'd like to chat further. We're going to be here. Martin, I'm going to get you back on the show. This is a fantastic hour. I really, really value your time. You're an incredibly busy guy, and I'm thankful that you spent the time with me, with our clients and our viewers. Merci beaucoup, Martin. Everyone, thanks for tuning in. Joyeuse Pâques. Happy Easter. Take care.
Bye-bye.
Merci.
Bye.